Better System Trader, episode 59.
Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Hey there, welcome to episode 59 of the Better System Trader podcast. I'm your host, Andrew Swanscott. Thanks for joining us. So, who wants a steadily rising equity curve with little or no drawdown? I'm sure most traders do. I definitely do, but unfortunately, it doesn't usually end up that way. Drawdown is obviously a big part of trading, and it can be one of the biggest challenges that we face as traders. So, what techniques can we use to potentially help reduce drawdowns? Our guest for this episode, Scott Phillips, is going to share some techniques that he actually uses to manage drawdowns in his own trading. And in our chat today, you'll learn how to quickly test a trading idea to determine if it's worth more investigation, why it's so important to understand market types, the impacts it could have on your trading results, and how you can leverage this knowledge to create strategies with enhanced performance, and also how to improve your trading results through better trade management and multiple exits. But before we get to the chat with Scott, let's just hear a quick word from our sponsor. Market System Analyzer is a software product designed to help maximize the performance of your trading strategies. It can be used to analyze and provide detailed performance statistics, find the optimal position sizing to reach your trading goals, detect over-optimized trading systems and prevent curve fitting, assess the sensitivity of trading results to trading order, and it also contains features such as Monte Carlo analysis and equity curve trading. So it's got loads of great functionality for traders, and at marketsystemanalyzer.com you can download a free, fully functional 30-day demo. So for more information, check the show notes page at bettersystemtrader.com/59. And now on to our chat with Scott Phillips. Hope you enjoy it. Hi Scott, thanks a lot for joining us today. It's great to have you here.
It's great to be here, mate.
If you can please just start with giving us a little bit of background on yourself.
Okay, it's kind of difficult because I spent the first, decade and a half of my adult life more or less as a drug addict and criminal. And I don't really like to sort of dramatize it or make it sound better than it was. It was kind of sad and pathetic and miserable. I used to wake up every day and shoot up crystal meth like you probably have a cup of coffee in the morning. And by the end of it, I was just completely insane, and you couldn't imagine a messier life. And I'd done a trading course with a guy called Ivan Krastens, who came in and stayed with me for a while and taught me his systems in 2002. And I wasn't very good at it. I'd blown up a $20,000 account, but it was something that I wanted to do. So I ended up going to prison for a while in 2006, and I got all these books sent to me about trading, and I read all the stuff that everyone's read. So I read as close to every written word on trading as I could possibly get, and I had people phone me in the open, high, low, close data and of a couple of markets, and I would write my own charts on scrapbooks and start to figure things out. Anyway, I got out of jail and I prepared seriously for about another year, and then put $100,000 in an account and blew it all up in short order. And like we're prone to doing, and then I got in touch with my old mentor again, and we started trading systematically. And I was really convinced this guy was like a complete guru. Like, he told a good story about being a consultant for hedge funds, and he had a talking head spot on CNBC in the 80s, and he traded systematically. Like, he really did trade systematically. There was only one problem, was that his system wasn't an edge. And I figured that out. A bit too late. So eventually I realized that I would need to build my own systems, and I sat back and I modified this guy's system that he had taught me, removed the worst aspects of the negative edge about it, and changed the exit algorithm, and did a few other things, and came up with a positive expectancy system. And I traded it faithfully and well for a year, but with an R value that was so high that I was undergoing real risk of ruin. And so anyway, I got away with that for a year, and I did 108% for the year. But it was pure luck. Like it really could have gone the other way, trading at 5% R values. But it convinced me that system trading was the way, and if only I could get better systems. And when I decided to get serious about this, I tried to build better systems, but because all I really knew were this guy's setups, I had this situation where all I had was a hammer and everything looked like a nail. So I did a couple of seminars with Van Tharp's guys, and I went and did a Forex trading seminar with a guy called Gabriel Grammatidis, who has an excellent system. It's a bit too discretionary for my take. It's very subjective, but the fundamental basis of what he was trying to do was to buy pullbacks in uptrends. And he was trying to buy, and how was he measuring an uptrend? He was measuring an uptrend by saying it's an uptrend on a daily, it's an uptrend on a 240-minute, it's an uptrend on a 60-minute, and an uptrend on a weekly. And if all of them together are uptrends, then you've got an uptrend. And I thought, oh, wow, that actually makes sense. There's an objective definition of an uptrend, and here's something he's trying to do. He's trying to buy a specific type of pullback. He was looking for a pullback that went on, his system's too complicated to go through, but he was looking for a system, he was looking for a pullback that on the 60-minute charts was between the 8 and 21 exponential moving averages. And, not that there's anything magic about any moving average, but moving averages are nice sort of, Fisher Price, my first system. They're nice tools for objective system building. So anyway, I sought to develop the fundamental properties of the discretionary system I was trading into a daily chart pattern system. And the Van Tharp approach is to spend a lot of time, which I've adopted mostly, is to spend a lot of time developing system goals. So the system goals for my system were fairly modest. I wanted to make 40% a year. I wanted to be daily chart pattern system only, trading major FX and major futures contracts. And I wanted it to be. I wanted to only have to look at one chart. I didn't want to look at multiple time frames, and I wanted it to be objective.
So can you tell us a little bit more about your actual trading style? Like, what's the core concepts behind your approach to the markets?
Okay, so what I'm looking for is objective definitions of classical trading things. So for example, are you familiar with what an inside day is?
Yep.
Objectively, an inside day is a day where the high is lower than the previous high and the low is higher than the previous low. We cannot have an argument about that. It's an objective definition. So if you drop down a time frame from an inside day is a lower time frame trading range. Like invariably, what's an inside day on a daily chart is really a 60-minute trading range, and eventually it's going to break out one way or the other. I mean, that would be the simplest answer. So, yeah. So if we think about what we know about trading ranges, breakouts from trading ranges, while the market is sideways, tend to be a low edge. Like a breakout is a low probability, but a breakout from a trading range in a trending market tends to be more real. I don't think that's particularly controversial. So one of my early trading systems, I was looking for an inside day in a trending market, and I defined trending as very simple, with just two moving averages crossed over each other. Because I tried a bunch of different things to objectively define trending, and I still have, and I'm always looking for better things. And sadly, I haven't found anything that really overall works better than just the really simple, stupid stuff. So, for example, if we were going to define a double top, the setup I use to define a double top is a thing called a fake out. So we're looking for, firstly, a spike high, which is defined as a bar with a lower high before it and a lower high after it. Then number two, I'm looking for a number of bars which fail to make the failed to break the old high. And then number 3, I'm looking for a bar which breaks the old high, and then I place an order to sell short if it opens in the range and breaks the daily low with a stop at the high. So in that way, I'm trying to get away from the subjective notions that people have about this sort of McGee and Edwards classical charting stuff, which you can build systems around, but have absolutely no predictive value. So another one would be retests, which we know quite often happen at changes of trends, gaps. I'll send you the links, but I've published them all previously. There's about 13 different setups, and I use these as a toolkit for building systems. And what I like to do is to think about some property of markets which is really uncontroversial, like the simpler the better. In a trading range, breakouts are probably going to fail. That's an example of a proposition which I think most technical analysts would agree with. Or in a trend, pullbacks in an uptrend are an edge. Or there's or volatility edges. When volatility reaches a historic low, the next breakout is probably going to be tradable.
Yeah.
Things of that nature.
Yeah. So you're talking about patterns there, and I think even if you just look at candlestick patterns, there are so many that have been defined. I guess, I don't know, maybe hundreds. But I think a common issue for many traders is that there is a lot of ideas to test, and I personally, I've got pages and pages of ideas that I want to test, and that list keeps getting longer. So I know
I tested all of the Steve Neeson candlestick chart pattern books. There's not a baked bean worth of useful or tradable information, and there's zero edge. By the time I was done testing all of his stuff, I was like, oh no, candlesticks are a dry hole. And there's other sites where the statistics that are published are like a work of fiction cut from entire cloth. So you really can't trust the stuff that you see on the net. You have to actually roll up your sleeves and get dirty yourself, because really there's a lot of active disinformation and stuff from people who obviously don't trade themselves. And in the 70s and 80s, the quickest way to be a guru was to invent an indicator, name it after yourself, or invent some method that made it sound all mystical. And there's just a tremendous amount of that stuff still clogging up the internet.
So if you actually tested all those, that must have been quite a lot of work. So did you have any kind of idea or process on how to speed up that testing to kind of identify quicker which were worth more investigation? As
it happens, I do. So because I'd come across this property of systems that work are okay. You have to, if you understand confidence intervals and statistical significance, you would have to know you need a tremendous amount of back testing to actually be sure that you have an edge. An amount of back testing that actually for most traders is not practical to get that amount of data. So there's a shortcut. If I can see that a system maybe not a big edge on. Systems that are a real edge are more likely to be an edge across markets. If I see a system that someone's saying it's just a gold system or it's just a bond system, I would say that's more likely to be a system that at some point stops working completely. If I see a system that works daily charts but not weekly charts, I would say that's more likely to be a system that's not what I call not robust. So when I do rapid prototyping of systems, an easy way to do it is to look at your entry point and any reasonably chosen stop loss. And you could choose it by an ATR multiple, a candle spike low, a recent candle spike low. It doesn't really matter as long as it's not some sort of arbitrary random sort of thing, like something that as an experienced trader you can say is reasonable. If I look at the total amount of R I'm going to get from a winning system, if I do an exit at 1R, if I do an exit at 1.2R, and if I do an exit at 1.5R, and I do an exit at 2R, all four of those are going to be positive. It's just a straight limit exit, just like a stop loss target, like nothing fancy, no, like as a base. So as a base testing, what I do is I set up a pen and paper with 3 columns: win, loss, and break even, and I do little pencil cross hashes, like 1, 2, 3, 4 cross, like, you know what I mean? And I do, did it get to 1R, or did it get to 1.2? Did it get to 1.5? Did it get to 2? And I'm just eyeballing it. I only get out the calculator and work out the exact ticks if it looks really line ball. Because at the moment I'm looking for really rapid prototyping. I pick random price action, what a quant would call out of sample data, and I try my best not to cheat, which is kind of difficult. So I sort of shut my eyes and hit the mouse a bunch of times, and or ask my girlfriend to come in and hit the mouse a few times, and you've got to be true to yourself. And then I just crosshatch out win, lose, or draw until I've got 100 trades. And 100 trades is not a statistically significant sample or enough to get any sort of decent confidence interval, but it's enough to throw away terrible ideas. And I can get, what I believe is that if it looks good at a straight 1R exit, so by 1R I mean if you're risking 100 pips to make 100 pips, that's 1R. Risking 100 pips to make 120 pips, 1.2R, and so on and so on. So if it looks positive on all four of those, and on top of that as well, the total R at the end all looks reasonably similar. So one of the things I'm looking for in a system is I'm not looking for the optimized best parameters, because by definition the past and the future rhyme. They rhyme, but they're not exactly the same. So if I optimize for the past, by definition, I'm not optimizing for the future, right? So what I'm looking for is a decent number in a forest of decent numbers. I'm not. If I see a system that looks great on a 2R limit exit but doesn't make money on any of the other exits, I'm thinking, wow, there's something weird here. This is stinky. It's stinky. So anyway, I do 100 trades manually, and is it worth further investigation? If it's worth further investigation, then I'll do a proper back test for a number of years, and do it properly, and eventually, before it goes into production, a proper computer back test. But yeah, that's my approach anyway.
Okay, I've heard other traders, they actually do a similar kind of approach, but they just measure it in days after, so they'll see what the result is 1 day after, 2 days after, 3 days after. But
I think that's the process, and it's really good too.
Yeah, okay. All right, thanks for sharing that, Scott. Now, I'd just like to switch gears a little bit to market type, which you mentioned earlier. Now, I know you've done a lot of work with market type, and it's a key consideration in your trading. So I guess, first of all, can you explain what you mean by market types and why you think it's so important when trading?
Okay, so in at any given time, markets spend most of their time going sideways, and then they trend, and they make most of their price gains in a relatively small amount of the time, which is one of the things that's incredibly frustrating about trading. Is that markets behave almost completely differently when they're sideways and when they're trending, and they also behave completely differently when they're low volatility and when they're high volatility. So imagine a matrix where we've got bull, bear, or sideways, and low volatility and high volatility. We've got 6 different possibilities. Now, from say 2010 to arguably last year, we had a low volatility bull market in equities in the US. So I don't think that, and you can look at any sort of measure of volatility like ATR or standard deviation or real volatility or implied volatility. The wiggles are getting smaller and smaller, and a low volatility bull market is a very benign environment for buy and hold traders, which is why the bulls have just looked so tremendously clever. And another thing is that in low volatility bull markets, counter trend setups have a dramatically lower odds of working, which is why you get all these technical analysts complaining that the the markets are rigged, but the markets aren't rigged. Well, they, except not in the sense that it's not like the central banks didn't tell you exactly what they were doing. They said they were going to rig the market. They said the direction they were going to rig it in, and it's entirely possible to trade along with that rigging. They didn't do it unfairly in any way, shape, or form. But my point is that if you look at technically perfect short setups, have failed again and again and again and again. And times that I've looked at this at especially US equities and thought, wow, that's a top for sure. Goes down a little bit, surprise, bam, QE2, QE3, whatever happens, and then the shorts get squeezed out and it fuels the next leg up. So if we look at decreasing volatility, low volatility bear markets would be the hardest markets to trade, the shortest markets to trade. In my opinion, barely worth building systems for. The last couple of months before we hit the bottom in 2009 would be an example of that. Really, really difficult, choppy, going down in an unsatisfying fashion. That would be an example of a market that I just wouldn't want to build a system for. And if we look at a high volatility bull market, think say a 2001 blow off top, or any of the commodity, like the 2008 bubble in oil, or virtually Bitcoin last year, or any sort of bubble that you want to see. A high volatility bull market is an entirely different thing than a low volatility bull market. A low volatility bull market, you can be really comfortable with pyramiding up a position. And a low volatility bull market will likely last for years. Whereas a high volatility bull market is typically the end phase preceding something else. We compare that to sideways markets. A sideways high volatility market, like say what they had in the 70s, very tradable. The trend followers all looked like geniuses back then because the stagflation and inflation directed these huge trends in commodities, which made trend followers look amazing. We don't have that right now. So a low volatility sideways market can be very frustrating to trade. But in essence, if you're in a low volatility sideways market, what you want to do is try and buy somewhere towards the bottom of the range and try and scalp. So you're not trying to hold for a new trend. You're not trying to guess breakout. You're just trying to buy where the risk reward is favorable and be in and out quickly. And totally viable strategy, especially intraday. How do you define low volatility? There's a bunch of different ways. All of them are completely unsatisfying in my view. They all fall apart. They're all approximations and unsatisfying. You can look at standard deviation, which is essentially Bollinger Bandwidth. You can look at ATR. You can look at improved measures of ATR. You can look at average candle size. You can look at implied volatility as measured by the options market. None of them are entirely satisfying. But for me, what a low volatility sideways market looks like is a market where all of a sudden you get a lot of choppy, overlapping price action. So you get 2 bars up, 1 bar down. You get a lot of outside period bars. You get a lot of doji looking bars. You get a lot of what looks like random walk price action. And what it represents is that bulls and bears are fairly evenly balanced, and we've got a tug of war. And if you imagine 2 prize fighters standing in a ring punching each other, eventually one of them is going to punch himself out, and only the buyers or sellers are going to be left. And that's the way I look at it.
Yeah. So when you're actually developing a trading strategy or testing it, at what stage do you actually consider the market type? Like, do you choose a market type first and then try to develop something for that, or do you test an edge and see where it works? Or what's the process for you?
There's 2 approaches. I've tried it both. My preference now is to build the market type as a fundamental property of the setup that you're looking at. So if you're trying to trade trending markets, it makes sense you've got 2 choices. You could put an overall framework trying to measure trend and only trade those markets which are trending according to your whatever indicator, whatever you want to call it. So it's like a switch. This market's trending. Okay, so we start trading. Now we look for now we look for XYZ setup. So the problem with that is that the definitions of trending that I've always been able to come up with are unsatisfying. They're always a bit late onto a trend. They're always approximations. It's a model which breaks down. So the other way is to say, for example, if we're looking to trade sideways markets, let's trade a market where we're below 50-day highs and the upper Bollinger Band is falling. That might so that would be a way of building into the system that we're really not trending. Like we're below highs, the Bollinger Band is falling. We've at least got some evidence that maybe we're transitioning from a trend to a trading range. It's not a real example, but my preference is if I'm looking for trending markets to have the trending as a precondition of the system.
Yeah.
If you know what I mean.
Yeah. So
I'm not sure if I made that clear.
No, that's clear. Yeah. So in your research, what kind of impacts have you seen market type has had on trading strategies?
Oh, it's huge. By definition, it's going to be impossible for me to build a trading strategy that works in trending and sideways markets. If you think you've got that, I don't think you do. Like they just behave so differently. So my own systems fall apart really quite badly in sideways markets, and that's just the way it is. And so then you've got the choice: do you want to do some sort of trickiness over the top to stop trading or lower position size when your systems are underperforming? And you can do things like, say, take a 20 period or a 30 period or a 50 period rolling expectancy of your trades, and when they fall below the mean, reduce position size or stop trading altogether. Some people run a moving average over the equity curve, which I've done with one of my previous systems. System falls below the below the moving average of the equity curve. Trade it for 1/10 of the size. Takes the heat out of some of the drawdown. But my experience is that doing trickiness, equity curve trickiness to adjust position sizing, can create problems that it solves. So Laurent, he said that complexity is a form of laziness, and I've experienced that myself because, for example, I started doing equity curve trickery with my core system. So it falls below a 20 period moving average of my equity curve. Position size goes down. But what I found is that because you try and let your winners run, my average winning trade lasts like 6 times as long as my average losing trade. So your losers are over really quickly, and your winners are still going. So you're switching off to a lower position size when really you haven't quite got the evidence for it yet. So I must admit my experiences with that are unsatisfactory, and at present. It sounds a bit like voodoo, but when things are going a little bit too good, too well, and I have that feeling of euphoria, like I have that feeling of, I remember just before my first big drawdown trading this current system, I went shopping for real estate at Sunshine Beach, and it was like, that was the absolute geometric top of my equity curve. Thank you. It was like, oh yeah, so every time I feel like really clever with myself, it's like, yeah, okay, we're not going to trade for 1% now. We're going to trade for 0.5%, and that's not scientific at all. And I'm actively working on ways to improve that, but that's a work in progress.
Yeah. Okay. So earlier you touched on building robust systems, and you mentioned that your systems were based on fundamental properties of the market. Do you think by having a market type in there, is that actually improving the robustness, or is that making it too specific going forward?
I think it improves the robustness if you can trade a system all the time on any markets, and in the bad periods it's not going to lose too much, and in the good periods it's going to make a lot. So my preference is to just keep trading, not have to do too much trickery. I call it polishing the turd. So if if a lot of people have these shitty systems and they'll like a turd that they roll in glitter to make it somehow a positive edge. They do whatever trickery they're going to do. They're like, oh, it doesn't work on ZB, but it works on ZN. Like, to me, it's the reddest of red flags. If a system works on 30-year bonds but not the 10-year note, for example. So I prefer a system that it's just me. I prefer a system which is going to be a modest expectancy system. Like, none of my production systems are much above 0.2 expectancy. And my core system is 0.11 expectancy, which is very ordinary by any professional standards. Which means if I'm risking 1%, I take 100 trades, I'm going to have 11%. That's what 0.11 expectancy means. And my core setup, that's what it is. It's not. And I have and it's worked across a number of markets. And I have every expectation that it will continue to work in the future. So what makes me really nervous is for example, I've got a really good friend who runs evilspeculator.com, who's a great programmer, and we learned most of what we know about system building together, and he builds these very complicated systems which are prone to stop working, or when they go out of sync, they look really, really good, and then they go out of sync. And to me, trading is just such a frustrating business to be in, to do it properly. I prefer to sleep at night, if you know what I mean. I wake up every day, I see what setups are there, I take the setups, I log them in my spreadsheet, and then I go away. Like, I don't really want to have the back of my mind wondering, is my system still a system, or is it going to blow up my account?
So do you actually stop trading a system when the market type switches, or do you just reduce the position sizing?
Personally, no, I just reduce the position sizing, and it's only just a little bit, to be honest. Like, right now, my core system is robust enough that I'm cool with it. Drawdowns are drawdowns. You can try and be a bit clever and take the worst out of the heat, but really, drawdowns. If you want to avoid drawdowns, stop trading. It doesn't feel very nice. I try and be a bit kinder to myself when I'm in drawdown. The very nature of trend following systems is that, of the last year where I did really well for the year, I spent 10.5 months below peak, out of the 12 below peak equity highs. So you're spending 10.5 months in drawdown. Like unless you're actually comfortable with losing money, this is not the game for you. You need to find something else. And typically I make most of my money in, three or so on average decent runs a year, and they last, between a month and 2 months, and everything else I just lose little bits of money. That's just the way it is.
Yep. So if building strategies that take advantage of specific market types can help with reducing drawdown, do you have any other approaches that you use to try to reduce drawdown in strategies?
So we were talking about what I believe is a fundamental property of robust systems, that on any reasonably chosen exit algorithm, they will produce roughly the same amount of total R. If you think about what Sharpe ratio is, or what Van Tharp system quality number is, they're all heavily dependent on the standard deviation of returns in Sharpe ratio and in terms of Van Tharp system quality number, standard deviation of trades. So if you can decrease the standard deviation, most trading systems rely on the fat tails distribution of winners. So you're holding out for the 10-bagger winner, right? And you might have 6 losers, and then you get a 10-bagger. And that, by definition, is going to give you bigger drawdowns, because if you're working on waiting for a big winner to make all your losers back, that big winner could be a long time in coming. So there's two very easy fixes to drawdowns. The first fix is to bank partial profits along the way at a point that doesn't sacrifice your total return too much, but reduces the standard deviation of your winners. So if you're reducing the standard deviation of your winners, if I'm banking, let's say if my trade gets to 2R and I'm banking half the profit, which is exactly what I do in my production system, for a start, I've got half the risk off the table. And sure, I'm forgoing the possibility of me eventually getting a 10-bagger out of the remainder, but really what I'm trying to do is reduce the standard deviation of my winners, because amateurs think about how much they're going to make and professionals think about how much they're going to lose. And my mind is always focused on the drawdown. The other approach you can do, which works really, really well with very marginal edges and marginal systems, is to do what I call a sign of weakness exit. So let's say your average win was 1.1. Let's say your average win was 1.1R, right? So you risk 100. So you risk 100 ticks, 100 pips, and you're making 110 on average on a winning trade, right? Okay, and your average losing trade is 1R because you're just setting a stop loss and leaving it. That would be an extremely marginal system. That would almost be an untradeable system after comms and slippage. But what you can do is identify the types of price action that invalidate your trade and make it not such a good trade within the first couple of days, within the first couple of bars. So quite often you get you get an entry on a trade, and the first day's price action you go, oh, that doesn't look good, and you know what I mean?
Yeah.
And sometimes it comes good, but really, like, the odds after that first bar, you're hanging in hope, and the odds are against you. You know, the odds are really not in your favor anymore. So what I call a sign of weakness, there's a couple of ways to do it. You can do it, first of all, you can do a time-based stop loss. So if it doesn't make 1R in profit at least within 3 bars, exit, win, lose, or draw. You're going to get a bunch of small winners and a bunch of small losers, and those small losers will average down one average winner and a 1 average loser. You've got a 1.1 average winner and a 0.8 average loser. All of a sudden you've got something there. If the difference between your average winner and your average loser is 0.3, like, you really have something. You have a real edge. So in doing that, you've taken this crappy system and turned it into something that's almost viable. The other way that I do it is, for example, if I'm entering on a break of a hammer candle and I get an immediate shooting star candle, which is a shooting star is a candle that's tried and failed to go up. To me, that tells me that breakout's failing. I jump out. That day. So it'll either be a small win or a small loss, but because it decreases the average loser, overall, it makes my win. It makes my expectancy jump dramatically. The other way you can do it, which is popular in volatility breakout systems like Bollinger breakout systems, like Keltner inside Bollinger systems, is any trend day, and you define a trend day differently, but a trend day is like a 1% or above move in the S&P. You build your own parameters for it, but we all know what a trend day looks like. It's like a big range bar which opens at or near the lows, closes at or near the highs. If you're going short on a breakout system, and you see a trend day in the opposite direction as your entry within the first 3 or 4 days, that's a good time to get out of that trade because the odds are no longer in your favor. And, you know, stop losses are inefficient. Like waiting until a trade actually hits your stop. You know, there are times I want to be in a trade where the odds still favor my trade working. When the evidence changes, part of what we're doing as traders is interpret the constant flow of information that we're getting in the now moment. Like, we get this constant stream of information and we need to interpret it objectively. If I'm not biased as towards my position, if I'm not talking up my own book, and I see evidence that this trade is no longer in my favor and I'm really just hoping against hope like a sucker, I want to build that into my system so that I get out. And in doing so, I want to lower my average loser.
Mm.
Make sense?
Yep. So with this sign of weakness exit, though, I mean, how many exits should you then have? Does adding these additional exits produce an even greater opportunity for curve fitting?
Anything you're doing, any extra parameters you're putting on your system are exposing you to curve fitting. So to a certain extent. So my view is that anything that you're going to add can't just be like an optimization and and see what looks best according to the computer backtester. It has to be based on a fundamental property of markets. So if what I'm doing is buying a breakout from support after a pullback in an uptrend, which is what my systems are based around, if I see that breakout is failing objectively, then I no longer want to be in the trade. If I just ran a bunch of backtest stuff and the backtest told me this, that, or the other, I would be very, very very dubious. And you can't put too much stuff in a system before it gets curve fitted. Like really, it's you can't have too many things before it gets curve fitted. We might talk a bit about exits and the best way to build exit algos, if you want.
Yeah, sure. It sounds good.
All right. So one of the things I noticed with Van Tharp's guys is and Van isn't a trader, but he's an NLP sort of guy. So what he does is he models all the good traders who come anywhere near them, and he's very good at extracting useful snippets of information. And one of the things his guys all told me was that most traders put their stops too tight at the start and too wide at the end of the trade. And so everyone's worried about being stopped out and they want to make the most money, so they trade these really, really tight stops. And at the end, they trail these really loose trails because they want to catch the big winner. But really, beyond a certain point in the trade, and for example, with Gabriel, whose systems I traded, once he got to 4R, he would tighten the trailing stop dramatically. So he would trail a very loose trailing stop, and then tighten that trail the further the stop went in his favor. So in my opinion, the best way to build exit algos is to pick a bunch of different exits that you like and race them off against each other. So what I mean is, for example, generally the best all-round exit for catching the bulk of a trending move is a trailing spike low exit. So you get a new spike low, which is a bar with a higher low to the left and to the right of it. You move your stop up to just below that. You wait until you get a new one. So you would run that trailing spike low exit. At the same time, you might trail a Hail Mary, stop well away as well, just in case it hits that. And you might trail as your trade got later in beyond a certain amount of win. So let's say above 4R, you could try things like an indicator-based exit. One of the things I've seen used successfully is when Bollinger Bandwidth turns down, tighten the stop, or when Bollinger Bandwidth turns down, bank partial profits. You could try things like the parabolic SAR exit is really good. After you've caught the meat of a trending move, you really don't want to get a 5-bagger and then end up only having a 2R win, because it's emotionally crippling to give back that much. You know what I mean? Like the further you go on into a trade, you almost want to be hoping that you get stopped out every day. So what I like with trend following systems is and I know it's mathematically suboptimal, but I really just want to bank a decent standard deviation of winners and get on to the next bet.
Yeah, so one of the main ideas behind trend following, though, is to hold on for those big winners to pay for all the losses that you incur along the way. So by this approach of reducing the standard deviation of returns by cutting the position a little bit when it's in profit, do you find then that skews towards the losses, because you're still taking losses at full position size, but you're taking reduced profits?
It reduces the profits substantially, but not as much as you'd think. But what it does is reduces drawdowns a lot more. And when we're talking about trading mostly leveraged financial instruments, the total profit is really a function of position sizing. Like, it's axiomatic that you achieve your goals with position sizing, not with very different than, say, trading like a pure long only stock system where you're not using margin. So for me, if for me, if I'm trading a system at 1% R value, that's eventually going to have a 30R drawdown. Because you've got to remember that all these standard trend following systems actually have 40R drawdowns. And don't get me wrong, my superannuation fund is invested in one of those trend following systems. I love it, but they get 40% drawdown. It's emotionally extremely difficult to accept regular 30% and up to 40% and 50% drawdowns, and most people just don't have the balls for it. You know, and by doing the difficult thing, the fat tails distribution of the fat tails nature of trend following kicks in. That's where the edge comes from, right? So yeah, you could do that, but that would make systems which for the home trader are generally quite untradeable. I don't know. Trend following, for example, regularly has 3 losing years in a row, regularly gets out of sync with the market, regularly gets 30, 40, 50% drawdowns. If you look at, say, Dunn Capital, which is probably the best trend following long-term 40-year record, they've got just an astonishing record. It's just unbelievable. But the amount of times they've actually had 60% drawdowns. It's like, can you imagine explaining to your investors on a regular basis that you know what I mean? For the home trader, that approach is it's hard enough. Honestly, being a little guy at home, trading your account, trying to compound a little account into a big account, it's really one of the most difficult things I've ever done, and I've done some difficult things. I'm all about. I'm very focused on not having to go through that hell. And I've been through big drawdowns before, and it's not much fun.
Yeah. All right. Well, thank you very much for that. It was really interesting to hear about those exits and the sign of weakness exit. Sounds like something really interesting to try out. Now, I'd just like to finish up with some quick closing questions.
Sure.
Okay. So what's the biggest lesson you've learned through trading?
Everything that made me a good business person or entrepreneur, my courage, my willing to stick things through, the force of my convictions, my belief in myself, none of that was relevant to trading markets. And I had to actually change my personality before I could trade successfully, because the person I was the classic I lost before because my personality was that of a market loser, and so I had to change my personality before I could start to win.
Okay, thank you. So, what's the best trading advice you've ever received?
Look, if I had to give someone the best trading advice, is that trading is no difficult than learning to be, say, a very good martial artist or a concert pianist or a chess grandmaster. You're not going to learn just by doing. You have to sit down and say, I want to get to this level of skill and engage it in a structured, focused, practice way. The same way as if I wanted to be a black belt in some martial art, you wouldn't start doing black belt things. You'd start and gradually increase your difficulty, increase your skill level, and you'd measure everything. And you wouldn't trust anything that you'd heard. You'd test everything. And so that I believe trading can be learnt. I believe it can be learnt by anyone.
Yeah, okay, cool. All right, and at the start you said you've read a lot of trading books. So what are some of your favourites?
I love the Market Wizards books, like most people do. I like Reminiscences of a Stock Operator. I think Van Thup's books are good if you ignore the sales pitches in them, and his most recent book, if you ignore all the hippie stuff in it, because is very good, and in fact his Enter the Matrix or whatever book has everything that's in his seminars, absolutely everything that's in his seminars, in more detail than the seminars. I think that's quite good. I like Mark Douglas, and I read everything that Brett Steenbarger writes, including his blog, compulsive reading.
Yep.
Great stuff there. A few others, but yeah, that's about it.
Okay, great. And if for listeners who wanted to get in touch with you, how could they do that?
My email is scott@scalpius, scalpius.net. Happy to help anyone. I don't charge for it. I'm not one of those guys selling a course or a subscription or signals. I hate all that stuff. It's all just greasy and scammy to me.
All right, great. Well, thanks so much for your time today, Scott. Is there anything else that you'd like to mention before we wrap up for today?
No, I'm good, man. Nice to speak to you, Andrew.
All right, excellent. Well, thanks again for the chat today, Scott. It was really great speaking with you, particularly about the exits and the market types. I think will be very valuable for everyone listening. So thanks a lot for your time today and all the best.
Take care, mate. Bye-bye.
All right, cheers. Bye. Okay, a big thanks to Scott for spending time chatting with us for this episode. If you'd like more information, head over to the show notes page at bettersystemtrader.com/59. You'll find some more information there, plus also you'll get some details on how to get a free 30-day trial of Market System Analyzer software. So that's all in the show notes page, bettersystemtrader.com/59. Go check that one out. All right, well, thanks for joining us today. I hope you found the chat with Scott valuable and picked up some great tips from his insights. I've got another great episode for you in 2 weeks' time, and I can't wait to share that one with you, so I'm really looking forward to that. Until then, happy trading, and thanks for listening to Better System Trader.
Thanks for listening to the Better System Trader podcast. The next step is to head over to bettersystemtrader.com for more expert tips, practical advice, and exclusive content. Catch us next time for even more great ways to improve your trading here on Better System Trader.